The Fed recently raised its rate by half a point, which is the largest increase in 22 years. With inflation at a 40-year high, it's just hit 8.5% in March. Further hikes are expected in the rate later this year. But what does this actually mean for a normal person like me or you? And more importantly, what does it mean for your money and what should you do? First, it's important we understand what the Federal Reserve actually is. The Federal Reserve System, often simply just called the Fed, is a central bank of the United States, and it's arguably one of the most powerful financial institutions in the world. It was created in 1913 by President Wilson when he signed the Federal Reserve Act after a series of financial panics, particularly the Panic of 1907 when the US stock exchange fell almost 50% from its peak the year before. This led to the desire for a central control of the monetary system in order to alleviate financial crises in the future. Their number one job is to control the supply of money in the country's economy. While it has a range of different tools it can use to do this, raising interest rates has proven to be the most effective. And speaking of effective tools, so how does the rate work? The rate filters through the economy because it's essentially the rate banks charge each other overnight to lend money to meet the Federal Reserve requirements. This is called the federal funds rate. It sounds complicated, but it's actually simpler than you think. The Fed requires banks to keep a minimum amount of money in their accounts. Now, some banks have more than they need and some don't have enough. The banks with more cash lend it to the banks that need it. But with that comes an interest rate. Of course, they want to make money on that lending. This is based on the rate set by the Federal Reserve. The Fed rate is also tied to another benchmark called the Interest on Reserve Balances, or IORB. The Fed pays an interest rate to the bank's reserves money, which alters what the banks want to do. Put simply, when the rate is high, they're more inclined to keep money in the reserve, paying them a better interest rate. And when it's low, they're more inclined to lend money out as they'll get a better return elsewhere, i.e. mortgages and loans. So for example, during coronavirus, the Fed lowered their rate to 0, which made it way more beneficial to lend out money than keep it in reserves. Hence why there's so much money floating around. Now, interest rates are on the rise, but they're still historically cheap. The rate has been as high as 20% in 1980 due to double-digit inflation, and as low as 0 in 2008 with a housing crisis, and again in 2020 in response to the coronavirus pandemic. In May, they'll announce they'll continue to raise rates in order to deal with inflation. Now, in this scenario, it's easy to look at the Fed as this evil supervillain. But actually, its two main goals by doing this are to stabilise prices and maximise employment. If the US economy was a car, the Fed would be one of its main drivers. Economic growth is the speed at which the vehicle is travelling, and interest rates are the foot pedals that give it more or less life. It's a driver's job to give it enough speed to get through the humps and hurdles, but not enough that it wrecks. Cheap borrowing costs give the US economy more speed, propelling growth forward by bolstering asset prices and households. But more expensive rates cause firms to pull back on investing and hiring, no doubt influencing consumer spending along with it. The increase in rate is sending the dollar to record high levels, which makes import cheaper and exports much more expensive. This makes it harder for US companies to sell outside of the USA, which is partially why it has such a huge knock-on effect across the whole world. It will also send mortgage rates up, which will eventually cause the housing market to grind to a halt, as affordability becomes more of an issue. So what does this actually mean for you? Well, unfortunately, it means things are going to get more expensive in the short term, which will hopefully make things cheaper in the long term. Their main goal is to counter inflation. They essentially want to make it more expensive to borrow money. At the moment, it's at record cheap levels to loan money. Now, the sad part is about this with rising energy costs, people do really need it to be cheap at the moment, especially if they're already living on the breadline. Potential effects include lower wages, a halt or even drop in home prices, and a decline in stock market valuations. Here's some steps you should take in order to make your life a little easier. First, you should try to pay down any debt, especially costly credit cards or any debt on a variable rate, as it's set to rise. Consider fixing any rate you can now, the longer the better. Borrowing rates on personal loans and mortgages are set to rise, and the banks won't waste any time in doing it. Now is a very good idea to boost your emergency savings just in case you need it. And lastly, it's a good time to do things like switch your bank account to one with a good rate. Something a lot of us don't bother doing, but you should do it ASAP to get the best rate you can. These might sound like quite small, trivial things, but actually they're super important and can have a huge impact. So what does this mean for your investments? The rise in interest rates can affect the market in both good and bad ways. The The existence of interest, simply put, allows people to borrow money. The cheaper it is to borrow money, the more comfortable people are to borrow money to make big purchases like houses or cars. When they pay less interest, it gives them more money to spend, which can create a ripple of spending through the economy. Businesses can also benefit from low rates because they're able to take out cheap loans to invest in new equipment or expand their business. When rates are higher, consumers have less money to spend in the economy, and businesses just don't borrow as much money. And this leads to them not expanding and in turn not employing more people. So in theory, you would think this would affect the stock market prices. Well, not always. Dow Jones market data analysed the 5 most recent rate hike cycles to see what history says about the stock market returns in these periods. Their analysis showed that during 5 of these long-term periods, the 3 leading stock market indices only declined during one rate hike cycle, from June 1999 to January 2001, during the dot-com crash. This is an example of when you think things are always logical in the stock market and sometimes they're not. When factored together, the S&P 500 saw a median increase across all 5 cycles of 30%, while the Nasdaq delivered a median gain of nearly 27%, and the Dow Jones delivered a median increase of 17.4%. You don't have to go back far to find evidence that challenges the idea that rising rates lead to falling stocks. In 2017, the Fed raised rates more than 3 times, and the S&P 500 climbed more than 18%. In the immediate short term, however, this can differ. Here's a look at the performance of the S&P 500 over the 9 Fed rate hikes between December 2015 and December 2018. As you can see, the results are somewhat of a mixed bag. Sometimes it's raised immediately and lowered over the next month, and in others it's lowered and then raised over the next month. But a lot of factors come into this, like the current state of the market. With these rate hikes does come a lot of fear and uncertainty, and it sounds like they are punishing us, but in some cases it's actually a good thing. While the rise in interest rates is quite a complex topic, there's actually some really good things about rising interest rates. There will be higher returns for savers. Saving rates have been so long that people have actually forgotten that bank interest actually exists. This will be particularly helpful for retirees and your emergency cash funds. And believe it or not, it will actually become easier to lend money for houses in some cases. Sure, the interest rate will be higher, but banks have more incentive to lend out money, and they'll be keen to do so because they make more from it. Stocks will begin to trade more on their fundamental value and not so much on the central bank's monetary policy, as they're not going to be able to lend money so cheaply. And hopefully, as I mentioned, it will halt the growth in house prices, so it might help more first-time buyers get on the market. Eventually, if the plan works, it should help slow inflation, which will stop prices going up like crazy. And hopefully, in some cases, it might even make some things cheaper. Remember not to just be scared by all the doom and gloom thrown around with these kind of topics. There's always 2 sides to a story. And if you're worried about your portfolio, check out this mistake I made, and I'm sure it will make you feel a lot better. Thanks for watching, and I'll see you over there.